Hello, I'm Dan Ridsdale, Head of Technology at Edison, and today I'm joined by Greg Smith, Chief Executive of IP Group. IP Group is the UK's most active early-stage investor in science-based businesses. The company backs and nurtures companies across domains such as deep tech, life sciences and clean tech, with the general ethos of building businesses which create a better future for people and the planet. Greg, many thanks for coming in again.
Good to see you again. Thanks for having us.
Good, and you've just reported your interim results. Can you just summarise the progress that you've made over the course of the last 6 months?
Yeah, so as a reminder, the business case for IP Group, the investment case, is around offering investors diversified and liquid exposure to some of the most interesting investment themes over the next decade or two, so clean tech, life sciences and deep tech. And the half-year results, we think were a nice solid set of results. 3 key messages. The first, great progress across the companies that we highlighted at the full year would be catalysts for the coming 12-18 months. And that was sort of partly evidenced by the fact that they raised 300 million of capital across the portfolio in the first half. The second key message, and we've put quite a lot of disclosure around this, is that the businesses in the portfolio are actually really well funded. So about 60% of them are either funded to profitability or don't need to raise capital until 2025 and beyond. So it's, the portfolio is comparatively well funded. And then the third, and this was particularly important for things like SVB and some of the disruption we've seen in the first half, we've maintained our strong financial position at a group level, and we actually ended the half year with a bit more cash than we started the year, partly through realizations and partly through drawing down the second part of our fixed debt. So so we've good set of results.
And then looking at the key catalysts, what are the key portfolio catalysts that excite you the most over the course of the next 12 months and so?
So the overarching point I'd make is that after having built this portfolio for 15, 20 years, across the 3 themes, we really are approaching an interesting time over the next 12, 18 months in terms of key catalysts and delivery of value. One example is in the life sciences portfolio. We have 12 companies now that are in clinical stage development. Our holdings in those 12 companies adds up to about 25p a share. So about 40-50% of our current market cap, and they will be reading out over the course of the next 18 to 24 months. So really interesting catalyst there. One I'd particularly draw out is Istesso. It's a rheumatoid arthritis drug which is in phase 2b trials. We'll get the data in the first half of next year. And one of the things that we saw in the first half this year was actually quite a big uptick in biotech M&A. 2 interesting comps for Istesso. One was Nimbus, which was a phase 2 asset for psoriasis, another autoimmune condition, was acquired for 4 billion upfront with a couple of billion of milestones. And then another company, Prometheus, was acquired by Merck for about 10 billion, and that was for another immune condition, ulcerative colitis and Crohn's. So really interesting time for that life sciences portfolio. And then one I'm particularly highlighting this half year set of results is progress in a business called Hysata. This is the world's most efficient hydrogen electrolyzer company, about 95% efficiency. They've made great technical progress, great commercial progress, and so that's one to watch for the second half of this year.
Great, thanks. And the government's set out the goal for the UK to become a global science superpower, and obviously IP Group sits right at the centre of that. Can you discuss that ambition and the role that IP Group has to play within that goal?
Yeah, so this is one we picked up on when we were talking a few months ago, and so I said at the time, this sort of ambition to be a science superpower, I think needs sort of the 3 C's. We need capital, so that's more investors like us that have a long-term horizon and the expertise to be able to deliver this. We need conditions, and conditions is all around the governance, the regulation, the way that we think about being able to allocate capital, as well as things like Horizon Europe and the R&D tax regime. And then the third is about consumers, so the UK generally being consumers of our technology and our leading innovation where appropriate. So that sort of 3 C's continues, I think, to be the main driver. All of the recent discussion has been around things like the Mansion House reforms, which really covers the first 2 of those, so capital and conditions. And as you would expect, we've been very active in those discussions. And I'd say, as a group, we wholly support the objective and the long-term vision for the UK as a place to both start, to grow, to scale, and to stay for the world's best businesses. A lot of things have got to happen for that to be the case. We would pick out particularly that it's, I think, a really positive thing to see a number of the long-term capital providers, some of the DC pension funds, setting out this ambition to have 5% of their default schemes into unlisted assets by 2030, could unlock an extra 50 billion, which is great ambition and really good direction of travel. Exactly how it will play out, the industry is definitely working with, and IP Group, I think, can play a big role in that. So the way we could do, firstly, we benefit at the moment from a number of pension funds on our register. So we're a really nice way to get diversified liquid exposure to this sort of activity. The second is we manage about 700 million in third-party private capital at the moment. There's clearly an opportunity for us to do more of that on the scale-up front. And then thirdly, many of our portfolio companies will be raising growth capital over the next 2-3 years. And we think the quality of our portfolio will mean that it will attract a significant amount of capital, and so there's a great opportunity for those businesses to be funded and to really genuinely contribute to this very important growth agenda for the UK, and to make help to make the world a better place as well as valuable.
Thanks. And turning to the funding environment, over the period you completed 14 funding rounds, and the vast majority of those were flatter up rounds. Can you discuss the funding environment that you see going forward?
Yeah, so at a macro level, looking across VC globally, the funding environment has sort of probably, we think, steadied out. Over the last sort of 4 quarters, it's been a similar level of funding activity in terms of value and volume across the world. At about sort of 2018 levels. So there has been a general reduction, but it seems to be levelling out, which is good news for the portfolio. I mentioned earlier that our portfolio raised about 300 million in total in capital in the first half, and we were, I think it's good evidence of that old adage that great companies get funded in any environment. We, for example, had the largest ever investment into a UK quantum computing company. And so Quantum Motion completed a round, and some great co-investors. It was led by Bosch Ventures, and had Sony Innovation come in as well. So there really is sort of good evidence that we've got a quality portfolio, as evidenced by the amount of capital that's being raised, and indeed the quality of the co-investors. Looking forward, you're sort of always warned, trying to predict the future is a bit of a mug's game, but I think we're confident in both the funding position of the portfolio. As I mentioned, having about 60% of the companies not needing to raise capital for a good year or two, I think is really important. But many of the businesses will be hitting key milestones, and they should act as a catalyst for funding rounds. And I should be in a good position to report back at least on a handful of those when we see you for the full year results.
Look forward to seeing that news, and looking at the cash available. You've got 250 million pounds of gross assets to invest. How do you expect that to be deployed in terms of follow-ons, new investments over the course of the next year or so?
Yeah, so I mentioned the 250 million really in the context of financial strength, and it was a particular asset when we had things like SVB during the period. Luckily, us and our portfolio companies could manage that situation very swiftly and comfortably through that period. So we do continue to see that as being a strategic asset. In terms of the way we think about capital allocation, well, firstly, important to note that we continue to have this policy of supporting the capital growth with some cash returns through the dividend. We've got an interim dividend again this period. And in total, that means over the last couple of years since we changed to that new policy, we've now delivered about 70 million of cash returns to shareholders, which I think is vitally important in showing how we deliver value to shareholders. In terms of investment into the portfolio, the vast majority is going into the maturing companies to get them through their milestones. We still see a very healthy pipeline of new investments. I mentioned last time that one of the objectives for the clean tech bit of our business, Kiko Ventures, was to find new investments. I mean, interestingly, valuations are holding up so strongly there that we haven't done any new investments in that period, and that's because of the pricing dynamics. So we don't actually see compelling value yet in that space, but because we're a permanent vehicle and we don't have to invest on a fixed life, we can sit out of the market for 6 months, 12 months, and we'll be there with the expertise, with the team, with the knowledge to be able to take advantage of those opportunities when they do arise.
Interesting. It's great to have that optionality. And I mean, we talked about the vast majority of your funding rounds being up or flat rounds. How do you expect that to progress? Are you comfortable with the valuations in the portfolio as they sit right now?
Yeah, so the valuations are obviously a key consideration, and we speak to many of our shareholders about those. Actually, when we last met, it was shortly ahead of a valuations deep dive webinar that we did. It was very well attended. It's available on our website, so if you really want to see in detail how we go about this, then please review that. There'll be a link in the notes after this interview. I mean, we're very comfortable in as much as we have a very detailed process. We use third-party valuers where appropriate. A large amount of the portfolio is based on either mark to market because it's a quoted company, or last price. Generally, where it's not, then the larger assets we use a third-party valuer. And then on top of all that, the auditors review our comprehensive process. And for the last few years, they have to now report their views on our valuation, and they call us mildly cautious. So I think that's a sort of a relatively fair reflection of how we think about it philosophically. Of course, all the proof is in the pudding. When we sell businesses, if we've got the marks wrong, then that would come through quite clearly. In 2020 and 2021, we realised about 200 million a year from the portfolio. Actually, it was at about a 70% average uplift from where we had those holdings in the books at the beginning of the year. So hopefully some strong evidence that we take that mildly cautious approach.
Great. And to round up, no interview would be complete without the obligatory question on artificial intelligence. Obviously, you've got a track record in investing ahead of the curve. Can you discuss your position in AI, your holdings in AI, and your approach to artificial intelligence in terms of new investments going forward?
I mean, it's clearly one of the very big thematic areas in the last 6 months. Last year, it was all about VR and AR and XR, and this year it seems to be a lot more about AI. It won't surprise you to learn that we've got a number of holdings in the portfolio whose technological advantage is built around machine learning or AI. Great example would be Featurespace. They use machine learning to combat financial fraud, growing revenues very strongly, fantastic blue chip customers, pretty much uncapped market opportunity there. So exist lots of existing examples in the portfolio. One of the trends that we are following and have been investing in the last sort of year or so is the sort of compute implications for AI. What do the chipsets need to look like? How does processing work? And if people are interested in this topic, we've got a bit of a webinar coming up in the next couple of weeks, which is diving down a bit more into that aspects and looking at a couple of the investments that we have in that space and speaking to some of the thought leaders around how's technology going to need to change at the chip level in order to deliver the promise of AI. So if you're interested, dial into that and you can hear more.
Great. Definitely look forward to listening to that, and we'll put the links to that in the email as well. Greg, many thanks for joining me today. Really interesting.
Thanks for having us.